What are taxes? According to Investopedia, taxes are involuntary fees levied on individuals or corporations and enforced by a government entity, whether local, regional, or national, in order to finance government activities. In economics, taxes fall on whoever pays the burden of the tax, whether this is the entity being taxed, such as a business, or the end consumers of the business's goods. What does this mean? Let's break it down. This means that the government you live under funds society by obtaining a piece of your earnings from whatever it is you do to contribute to yourself, the people around you, and society as a whole. Why are taxes necessary, and where does that money go? Taxes fund the government. This includes public services, national security, government-supported organizations, benefit programs, maintenance and upkeep of government-owned properties such as roads and parks, and much more. The general breakdown of federal tax spending is rationed into many different areas. The majority of taxes go toward Social Security, which in 2018 took up 23.4% of total federal spending, national defense with 15%, Medicare taking up 14%, and health-related spending taking up 13.1% of total spending. There are many other areas that take up some percent of the total federal spending paid for by your tax dollars. What is a filing status, and how do you determine yours? There are different statuses of taxpayers. Your status influences your taxes. According to the IRS, your filing status is used to determine your filing requirements, standard deduction, eligibility for certain credits, and your correct tax rates. Your status depends on your marital status, as well as with whom you are filing your taxes. The status options are single, married and filing together, married and filing separately, head of household, or widow or widower with a dependent child. Who has to pay taxes? In America, taxpayers include anyone in residence in the country, no matter their legal status. There are different categories of taxpayers, including individuals, businesses, properties, some organizations, and more. However, there are exceptions within those categories. Here we are focusing on personal taxpayers rather than business-related. Personal taxpayer qualifications depend on the filing status, age, and income of the person. The minimum incomes to file taxes within each status and age are as follows.
What kind of taxes are out there? When people refer to paying taxes, it's a bit vague since there's many different types of taxes out there. For the purposes of this video, however, we'll be focusing on taxes that need active filing, like income tax. Other ones, like sales tax, are just automatically added when you purchase goods, so there's no need to worry about how to pay those. And since the US has different levels of government, like federal versus state level governments, they similarly rely on different levels of taxes. There's a general federal income tax, and some states have their own income taxes as well. Most do, but states like Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming all don't collect income tax. They just get the revenue from different sources instead. And out of all the states, California has the highest income tax rate of 13.3% on any income that exceeds $1 million. How often do you have to pay taxes, and are there exceptions? So you may have seen April 15 marked on calendars as tax day. This is the most common yearly deadline to file your taxes by. However, a lot of different extensions, delays, or deadlines that are changed from normal may apply to you depending on where you live and other such circumstances. So it's a good idea to do some personal research on this one just to make sure everything's squared away. So how does the government know exactly how much you owe? For income tax, it's a process that begins with you self-reporting your total income minus any deductions or tax credits. But do keep in mind, however, that the IRS keeps a close eye on any taxes that you file, and they'll enforce any tax code violations and investigate any purposeful fraud, so make sure to be accurate in your reports. If under some circumstance you just don't file at all when you're needed to, the government will charge an amount to you with their best guess, in addition to any interest expenses on your money and penalty fees for the late filing. But best practice is overall to just accurately file your taxes on time.
How do you figure out how much you owe? You can calculate the adjusted gross income, AGI, by subtracting any deductions that you're eligible to claim from your total gross income. The AGI then goes into tax brackets with different marginal tax rates to calculate how much tax you owe. Deductions are not taxed and are usually the result of expenses. If you spend a lot of money on medical expenses and charitable donations, you can increase your deductions. Deductions can include student loan expenses and moving expenses to take the first job.
What are tax brackets? Tax brackets are where economically you fall in the wider scheme of things. In the year of 2020, there were 20 different tax brackets, and they were divided into the following categories, depending on if you were single, married, filed jointly, or separately. Here is an example of where you may fall if you filed as single. For the purposes of time, we will not include how the government chooses to make these tax brackets, only where you fall in them. How do these two numbers work? The tax rate is the percentage of your income that will be taxed. Your income is how much money you made during the year. Please note, not all of your income is taxed at the same rate. What is the marginal tax rate? The percentage of tax applied to your income for each tax bracket in which you qualify. For an example of how it works, let's go through a scenario together. You made $35,000 for the year. How will you get taxed? You are put into the 12% category, but thanks to the marginal tax rate, you don't get taxed 12% of all of the money you earned. The money you earned up to $9,756 will be taxed by 10%, and the rest of your money will be taxed by 12%. So instead of owing the government $4,200, you now owe $4,004.88. The first $9,756 will be taxed by 10%, which will equal $975.60. The rest of your money, which will be $25,244, will be taxed by 12%, which will equal a total taxed amount of $3,029.28. which combined with the $975.60 will equal $4,004.88.
What are tax refunds? Taxpayers receive refunds when their total tax payments are more than the total tax. Tax deductions lowers tax, increase refund. It also has to do with what you claim. The fewer allowances you claim, the larger withholding amount, which may result in a refund. You can claim 0 allowances when you are listed as a dependent on another person's tax return. It is most likely to receive a refund. You can claim 1 allowance if you are independent and work 1 job. It is also most likely to result in a refund. You can claim 2 allowances if you are single. It's close to tax liability, but may result in tax due when filing taxes. If you are single and working more than 1 job, you can claim 1 allowance at each job or 2 allowances at 1 job and 0 at the other. If you are married, you can also claim 2 allowances. It results in a moderate tax refund. You can claim 3 allowances if you are married with 1 child. And you can claim more allowances if you file as head of household if eligible, and if you have at least $2,000 of dependent care expenses.
Let us wrap things up by discussing how taxes benefit you. Many people might ask, will paying taxes benefit me at all? The answer is yes. For one, taxes pay for the upkeep and accessibility to government-owned or funded organizations, properties, or programs. Without them, our country would not be able to fund our national defense force, let alone fund things like roads or libraries. It is also important that you file on time to avoid penalties and tax evasion. Many people also qualify for a refund, depending on their situation.